I'm Will Woodall, and I'm joined today by Mike Rarey as usual. Hey, Mike.
Hello, Will.
We're here for the May update to look at markets and what transpired in May, and then give you an update on our forward-looking outlook as things have evolved quite a bit. May was interesting. It was better than it felt, I guess, to say. Like, it was horrible for most of the month, and then the last week we got a little green action here. So I think we'll see the first green we've seen in a while here if we throw up the grid.
Yeah, we'll take a look at asset class returns. These are through the end of May, so we'll start with the column furthest to the left, and we see some very light green. Equity markets were negative for almost the entire month until the last few days of the month. That last week of the month, a very strong rally, best week for the S&P 500 since November 2020, and that got us back to slightly positive. We'll talk about the factors at play there within equities, but one trend that we saw was throughout the month of May, value outperforming growth. All of these positive returns came from the value side of the equity spectrum in US and foreign markets.
Yeah.
Growth indices all still with negative returns during the month, value positive. So a lot of noise in equity markets, a lot of volatility. Don't think this necessarily changes the trend, but a nice little respite from what we've seen here year to date in equity markets.
Yeah, I mean, bear market rallies can occur, and I think we saw, what was the last week's? Between 6 and 7%.
Yeah, pretty vicious.
But let's turn to the next slide and look at the actual underlying equity technicals, because it's really important to look at the magnitude of difference between value stocks and growth stocks. And depending on what you own, you could really be having a rough year versus being flat for the most part.
Right. Yeah. The type of equity you own this year has almost been more important than the amount of equity you own. And so looking at these 4 different indices we show here, this is growth of or percentage change year to date. So at the top, that would imply you're flat. So 4 different equity indices here, looking at their returns year to date. At the very top in the purple line, you see the FTSE High Dividend Yield Index. And this is a basket of US high dividend yielding stocks. And this has definitely been the place to be. These are price returns. So on a price return basis, only down 1.13%. That's better than pretty much every area of the bond market.
Yeah.
The only real asset classes that did better than this would be cash and commodities. And then if we were to look at this on a total return basis, which we don't have tick by tick data for, but it would be positive. So US high dividend yielding equities positive year to date and over the 1 year period. This has been a great place to hide out. On the other end of the spectrum, the green line, you see the NASDAQ 100. And you see the NASDAQ definitely in a downtrend throughout the year, at various points in that trend, but certainly in a downtrend, has been in a bear market since April. So more than 20% off the highs. And you see that very last week of the month there, an extremely strong rally.
Right.
A low volume rally. So all rallies are not created equal.
Yeah.
And rallies that are on high volume have a much higher believability rating than rallies on low volume in a Memorial Day week where a lot of people aren't trading and there's not a lot of activity. So it's quite possible that that bump that we had at the end of the month for equities in general, particularly for growth stocks, could be short covering, could be technical factors related to month-end rebalancing, but not a high believability rating. We would look at this chart and focus on the trend. Say the trend here seems to be down.
Yeah. And I think the other thing about this downturn in May in particular was the fact that the VIX was not anywhere near where it has been, which would signal that we're reaching some type of bottom.
Yes, that is true as well. Yep.
So trend wise, we're still in a bearish trend here.
Exactly right. And that's as dictated by our investment outlook. The trend here for equities is still down. This seemed like noise, the rally in the last week of the month. It does not alter our outlook. Positive returns for bonds, that's a different story.
Right.
That we view that as we are on the cusp of a regime shift in terms of inflation. We went from high and rising to high and falling, and that is a good thing for bonds. And so these positive returns for bonds we saw in May, that in our view could be the start of a new trend that we're pretty excited about.
Yeah. And how would you characterize, if we can throw that graph back up, the technicals, how would you characterize the trend in the value equities?
Yeah. So really trading sideways, but the macro outlook, everything in terms of low and falling liquidity, high and falling inflation, low and falling economic growth with spiking recession probability, the macro facts of life or a macro outlook, doesn't have a tremendous negative impact on high quality dividend paying equities. The implications are far worse for growth equities. Right. So the trend here is pretty stable. It's sideways. And as you're getting paid to wait, you're compounding 3% plus dividend yields, which are still attractive relative to yields you can find in the bond market in most instances.
Right. Okay. Yeah. Let's move on and turn to our outlook and look at the first factor that we focus on, which is liquidity, which is a very strong indicator for us as to where the puck is headed with economic growth and then eventually markets.
So when we had that rally the last week of May, as we said, it seemed like it was primarily technical factors. The one fundamental factor that some financial news outlets have tried to pin it on is the fact that one Fed official came out and said perhaps the Fed should take a pause in the fall.
Right.
After they've hiked interest rates through the summer, take a pause. And so you can see how that would be bullish for markets, reverse a trend. That would definitely be somewhat supportive. But we want to, we don't think that's the reason why there was the rally. But what we wanted to do is run that through our liquidity framework and see if it actually makes a difference in the liquidity outlook. So this chart is something we've shown multiple times. This is year-over-year change in the money supply, aka liquidity. Once again, money or the growth rate of the money supply is the fundamental above all fundamentals. If you grow the money supply, people have money to buy financial assets. Right. Prices go up. When money supply growth is slowing, that is a headwind for financial asset prices, particularly equities, particularly growth equities. And our base case scenario here, you see the light blue line is where we get out into the forecast horizon, is we're going to have one of the sharpest slowing, low and falling liquidity environments we've ever seen, with liquidity year over year, so money supply growth year over year, getting near 0% as we get to the end of this calendar year. And that's because the Fed is supposed to hike interest rates, reduce the size of their balance sheet, and we're not expecting any additional fiscal stimulus. So that's what we have in the light blue line. Not a great outlook for equities, something we've already talked about. But we wanted to put in some different scenarios here. One is a pause, the green line. And that implies after the July Fed meeting. So it's expected that the Fed will hike in June at their June and July meetings by 0.5% each time. And then after that July meeting, they pause. They stop. You could see how markets would say that's very bullish. But it will not materially change the liquidity outlook.
Yeah.
The damage has basically been done. The base effects and the trend here basically mean if they were to pause, we would still be in a low and falling liquidity environment. Still pretty negative for equities.
So said differently, perhaps our forecast is for it to continue to drop. A pause might stop it dropping, but it's not going to significantly reverse.
Right. It would help it bottom quicker. And if we can go from low and falling, bad news for equities, to low and rising, that could be constructive. But the rising part is something we're not going to get with a pause. That's going to be tough. So that's the first thing. The second thing is we took one step further. No Fed official has talked about a pivot, but hey, let's just take it one step further and see if the Fed were to actually pivot, meaning after the July Fed meeting, they then reverse the interest rate hikes we've seen year to date and reverse the balance sheet runoff. They unwind it. So they're cutting rates throughout the rest of the year. And you still see it doesn't have a material impact. We are going to be in this low and falling liquidity regime, even with a Fed pivot or pause through the end of this year.
And the likelihood of a pivot is extremely low. I mean, given inflation, given their credibility, we'd need another pandemic.
A lot of P's there. Yeah. Past pivots and pauses have been in situations where inflation wasn't running this high.
Right.
The Fed's policy response is going to be constrained by inflation. Think about the loss of credibility Jerome Powell would have, and the Fed as an institution would have, if they were to start cutting interest rates, even though inflation is running at 5-6% year over year.
Yeah.
It seems, as you said, a very low probability, very tough to think about. During prior pivots and pauses, inflation has been low. There have been no constraints on the Fed's policy response.
Mm-hmm.
They can stimulate, cut rates, react to the market selling off whatever they need to do without losing credibility. Very different this time.
So one scenario where they could, and we could talk a little bit about this, if credit starts to break significantly,
mm-hmm.
how could potentially they pivot without pivoting?
Yeah. One way you could see it happen is in supporting financial markets. So the Fed has multiple policy tools. They could say, we are going to continue with our interest rate increases because that is our primary policy tool that's going to slow inflation. But we understand the impact we're having on financial markets, credit markets, that can lead to bad economic outcomes. So let's provide some stimulus or some support with our other policy tools. Things like, hey, let's stop the balance sheet runoff.
Mm-hmm.
Maybe let's start buying some more treasuries just to facilitate financial market functioning, et cetera. There are a number of different facilities the Fed has to supply liquidity to the private sector. The repo facility is wide open. Nobody's using it. But if anybody needs support in terms of repo funding, that's there and available.
Mm-hmm.
So that's totally possible. The Fed using some of their lesser watched, less important policy tools to provide market support while continuing to hike interest rates.
Right.
That's possible. It's not going to change this liquidity outlook.
Right.
It's not.
Yeah.
It's a Band-Aid.
It's a Band-Aid.
At best.
Right. Mm-hmm. But it does go to the point that the credit breaking scenario might be one that would get them to
mm-hmm.
start to move in the other direction.
Yep.
All right, let's move on to the impact on growth. We have seen significant revisions to growth for 2022 and 2023, and we had a really negative print last quarter.
Mm-hmm.
What does the economic growth outlook look like now versus where we were end of last year?
Yeah. And this is our primary slide we show when we talk about our outlook for economic growth. So you look into the forecast horizon, the electric blue bars, if you will, and it looks pretty mundane. It looks
mm-hmm.
like just sort of a normalization of GDP growth around the median, 2.5%, ho-hum.
Yeah.
Nothing to get too excited about. But what's obviously not shown here is how these light blue bars have changed year to date. They've all come down quite a bit. And this is how the cycle seems like it's going to play out. It starts with the Fed reducing liquidity
mm-hmm.
dramatically. That impacts financial conditions. Financial conditions start to take the froth off of economic growth. Then that economic growth will start to deteriorate if the Fed continues. And eventually that will have real implications for the economy. So to that point, how much sort of froth of these on these expectations has come down, that's what we see on the next chart.
Yeah, and I think let's talk a little bit about the speed at which this is happening.
Yeah, definitely. So we'll start with that dark blue line. That dark blue line is the estimate for 2022 real GDP growth. So this is what we've been expecting throughout the year. So if we go all the way to the left, at the beginning of the year, expecting something like 3.9% growth, real GDP this year. And we're down to 2.6 now. Mm-hmm. And it's come down pretty quickly.
Right.
And it's pretty much been a constant trend downwards. Now, in the first part of the year, so we'll talk about the second, the bars, the green and red bars on the chart. Early in the year, our expectations for the full year were coming down. But the economic data, the real-time economic data, was coming in better than expected.
Mm-hmm.
That's where you see the Citi Economic Surprise Index above 0, which implies economic data in general coming in better than expected. So the expectations are coming down, but the data's beating. Plus and a minus sort of balances out.
Right.
Recently here, we've seen them both moving in the same direction. Not only have expectations come down, But the data is missing those expectations. The City Economic Surprise Index turning negative, pretty sharply negative. The most negative we've seen basically since the Delta variant came out and really put a shock to economic data relative to expectations.
Yeah.
So both of these things, unfortunately, are moving in the wrong direction pretty quickly. What normally happens is expectations get recalibrated to a lower level. And that's probably what we're setting up for. It's not great.
Right.
It's certainly not great news.
But they go lower, and then you get some beats and things turn more positives. But I think our data would suggest this probably has a ways to go.
As long as the Fed continues and the liquidity continues to bite, this is what it's biting. Yeah. Right?
Yeah. Okay. Let's take a look at the impact on the consumer, since it is the largest part of our GDP number here, and look at confidence versus sentiment. We've looked at this in the past, but we're starting to see some things here that would say that the consumer isn't in great shape.
Right. So the first thing you'll note, two measures, consumer confidence versus consumer sentiment. So we need to talk about how they're different. And you'll also notice the divergence. A big divergence here recently. Sentiment far lower than confidence. So we'll start with that. And sentiment continues to fall, basically the lowest since the 2008 global financial crisis.
Yeah.
And for the majority of this downturn in sentiment that we saw post-COVID, a lot of that was just due to buying conditions. Prices of things going up, very difficult to get items. Everybody knows it's a bad time to buy a house, even if you're not trying to buy a house. And also in consumer sentiment, it's not only about how you feel today, you're also surveyed on your expectations for the future. So if you have a political cycle, half the country basically says, based on who was elected, I have a negative outlook for the future. There was a lot of noise.
Yeah.
But as we look here recently, this recent downturn we've seen in sentiment year to date, it's not from conditions for purchasing durable goods getting worse. It's actually because of current conditions, current personal financial conditions starting to break down.
So give some examples of what that means.
Yeah. So how much do I have in savings?
Yeah.
How confident am I that I can go and get another job? How confident am I that I can continue to pay my bills? Those types of things. Your personal financial situation right now, not in the future.
Right.
That's a big reason why we've seen the green line break down further. And then also expectations for the economy over the next 12 months. That has broken down quite a bit.
Yeah, and there's degrees, the sentiment based on your income level. At the lower income levels, it's far worse than it is at the higher income levels, but it is breaking down across all those levels.
Yep. And that, because of why the sentiment is breaking down, hey, it's my current personal financial situation, my outlook for the economy in the near term, that's why we're also now starting to see a breakdown of confidence. Confidence, this is a current conditions index. This has nothing to do with your expectations for the future. That's a different index. We're not showing it here. But that's primarily based on how's your personal financial situation? What are your expectations for your financial situation in the near term here? How do you feel about your prospects to get a job, get wage increases, et cetera? And now we're seeing that start to follow downward as well.
Starting to turn down. And what does this tell us in terms of economic outlook and then potentially stock prices?
Yeah. So one, these numbers are still elevated. So we're not going to call a bottom in consumer confidence. No. And I think the Fed would look at this chart and say, well, this is exactly what we're trying to do.
Yeah.
We are trying to reduce demand by tightening financial conditions. Financial conditions are way tighter. Look at the Mongo board that we showed at the beginning of the video shoot. I mean, everything's red. Financial conditions are tighter, mortgage rates are higher, et cetera. The Fed is trying to slow demand by tightening financial conditions. And yes, that will impact consumer confidence. Yeah. That will impact how you feel about your finances, about your ability to purchase things. They're trying to soften the labor market. That will impact how you feel about your prospects of getting another job and your prospects for wage increases. So I think as long as these things are still relatively high, particularly consumer confidence, the Fed is fine with it. And they're fine with economic growth expectations coming down because their number one priority is to get inflation under control.
Yeah.
And unfortunately, this is the only way the Fed can do it.
Yeah. And the wealth effect has a huge impact on this also.
Yes.
And that's come down considerably.
Mm-hmm.
So let's take a turn and look at the recession forecast that we have.
Yep.
And make some comments here because we have seen it elevated. It's been very volatile. It's really based on mostly market data right now, but the volatility is something that we see generally trends towards a potential recession.
Right, exactly right. We all know that the financial market data has been extremely volatile and breaking down year to date. Thankfully, of the three primary types of data points that go into this recession forecast, thankfully, that's the only one that's really been breaking down. It's primarily market data. If market sort of stays where it's at in terms of, hey, we're flirting with bear market territory, high yield bond spreads are widening quite a bit, oil prices are very high. If that stays where it's at for an extended period of time, it will start to impact the economic data.
Mm-hmm.
That data is less volatile. It's primarily monthly.
Right.
You know, we can observe high yield bond spreads
Yeah.
all day, every day,
Yep.
right? So that will feed into economic data, which eventually feeds into the labor market. So that's a long way of saying the recession probability that you're seeing right now on the screen, 19% chance in the next 12 months, that is almost all due to the market data. It is the most volatile type of data that's in the forecast. So if we get a 10% rally here in the S&P 500, not calling for it, but if we did, that recession probability would start to come down even more.
Well, I think we even saw just in the last week of May, we went from 50s to here. So
we went from 53 down to 19,
right,
because it's being dominated
7%
by the market.
rally. Yeah.
Yep, exactly. So that's where it's coming from. You know, we always like to look at past analogs. When was another time that the recession probability got elevated above 50%, primarily due to the market data? And how did it turn out? And that was what you circled right there, 1998. Alan Greenspan was the Fed chair. You had a lot of negative financial things going on globally, Asian currency crisis, Russian sovereign default, et cetera. And Greenspan was not constrained by inflation, and he was able to pivot and cut interest rates. And that supported the markets. And you see recession didn't follow for quite some time. So, you know, if we thought the Fed had talked themselves into being able to pivot, or the inflation data was saying they could pivot, then, you know, we would feel much better that they could pull off something like Greenspan did in 1998, but it does not seem likely.
It's not the case now.
Yeah.
And just in terms of the inflation data, we haven't talked about it, but our inflation forecasts do show inflation coming down, so high and falling. What would be the case for inflation to sort of stay high? And at what level is it still alarming? It's like, I think we have it coming down to the mid 4s.
Yeah.
But like, what is the case for it to stay, you know, in the 6s through the end of the year?
Yeah. If you look at headline inflation, which includes food and energy prices, that could happen. I mean, we're seeing massive shortages of commodities, food, oil prices are still very elevated. So you could see headline inflation stay high. The Fed's more worried about core, obviously. They're somewhat worried about headline, but more worried about core. And at this point, if we were to see core inflation sort of move sideways, that would be a wage price spiral type scenario where, you know, the Fed doesn't hike interest rates like they say they're going to, and they let this sort of price increasing wage price spiral behavior get out of control. And that would be the scenario. And at what level is that alarming? Current levels. I mean, it needs to come down. Even if it comes down to 4%, that is still taking
high.
Prices that are extremely elevated right now and saying 1 year from now, they're going to be 4% higher.
Right.
That's not going to do good things for consumption. Yeah.
Well, that's good. Then maybe next video we'll dive into that a little deeper, but that's a great summary for the month. If you have questions on our outlook, want to discuss anything in here, please let us know. Give us a call. We're always happy to entertain questions and talk about our framework.